I'm Seth Kosich. Today we're going to explain how the Federal Reserve works and the monetary policy tools it has at its disposal. The Federal Reserve was created by the Federal Reserve Act of 1913. The Fed's dual mandate is attaining full employment and price stability. The Federal Reserve consists of a board of governors with 7 members. Members serve 14-year terms. The chairman and vice chairman are appointed by the president and each serve 4-year terms. There are 12 Federal Reserve districts, each having a Federal Reserve Bank. There are an additional 25 bank branches and approximately 3,000 member banks in the Federal Reserve System. The Federal Open Market Committee consists of 12 members, 7 members of the Board of Governors, the New York District Bank President, and 4 members from the other 11 districts serving 1-year rotating terms. Now Adam Montgomery is going to tell you a little bit about reserve requirements.
The reserve requirement is the amount of funds that a depository institution must hold in reserve against specified deposit liabilities. The effect of the reserve requirement is found by these 2 formulas: the money multiplier, which is 1 divided by the reserve requirement, and the change in money supply, which is the change in reserves times the money multiplier. High reserve rates are contractionary policy. In this example, there's $500,000 bond bought by the government with a 20% reserve requirement, which means that there will be $2.5 million made. This is found by 1 divided by 0.2, which is the reserve requirement, and the change in the money supply is the original amount times the multiplier, which gives you $2.5 million. Now on a low reserve rate, it's expansionary policy. The same example with just a lower rate gives you a money multiplier of 10. So you take the original amount times the money multiplier of 10 and you get 5 million. Now Shelby Bunn will be here to talk about the discount rate.
Discount rate is used to control the supply of available funds. When there is more money available, the more likely inflation will occur. A contractionary tool is raising the discount rate, making it more expensive to borrow, which results in the supply of available money being lowered. An expansionary tool is lowering the discount rate to bring the interest rates down, which results in a rise of the money supply. An example of this is when the discount rate reached its lowest point at 1% in 2003 in the result of the recession in 2001. This allowed more people to buy houses due to lower interest rates and lower mortgage payments. It also allowed homeowners to refinance their existing loans. This caused the quality of mortgages to decline. When interest rates began to rise in 2006 and 2007, refinancing was more difficult and defaults and foreclosures increased dramatically. This triggered a global financial crisis in 2007 and 2008. Now, talking about open market operations, here's Nathan Webb.
Open market operations were recognized by Benjamin Strong Jr., the governor of New York Federal Reserve from 1914 to 1928. He acted aggressively to create a recession in 1923 to prove that purchasing government securities could influence the availability of credit in the banking system. Open market operations are the tool that the Federal Reserve uses to manipulate the supply of reserve balances in the banking system, which can influence interest rates to increase or decrease in the short term. The Federal Reserve can alter the interest rates by buying government securities such as government bonds to expand the economy through lower interest rates, and by selling those bonds they can contract the economy through higher interest rates. So here's Michael Harper to talk about paying interest rates on reserves.
Interest on reserves adapted by the U.S. Congress in 2006. Legislation was supposed to go into effect beginning on October 1st, 2011. During the financial crisis in 2008, the effective date was moved up by 3 years through the Emergency Economic Stabilization Act of 2008. The Fed's new authority gave policymakers another tool to use during the financial crisis. Paying interest on reserves allowed the Fed to increase the level of reserves and still maintain control of the federal funds rate. In a contractionary phase, interest rates are high because banks hold on to more money. In an expansionary phase, interest rates are low because banks lend out more.